What are penny stocks and why are so many investors and traders new to the stock market drawn to them? In this video, I'll be breaking down what penny stocks are for beginners, the truth behind these companies, and what I believe to be the smarter way to profit from these penny stocks as a small-time day trader and investor. So, if that sounds like an interesting topic to you, make sure to subscribe, ring that notification bell, and drop me a like for more free day trading videos on this channel. Let's get started here. We all know that investing in shares of a stock means you're owning a small percentage stake of a company such as Apple, which has a market cap of $900 billion. Market cap refers to a total dollar value of a company's outstanding shares, and it's used by investors to determine a company's size. Penny stocks are companies with a much smaller market cap. Generally speaking, penny stocks are companies with a market cap less than $300 million. Definitions vary, but the Securities Exchange Commission classifies penny stocks as companies trading under $5. And many of these stocks, if maintained above the $1 mark, are still traded on the NASDAQ or the New York Stock Exchange, the more regulated stock exchanges. However, the true penny stocks are companies traded below $1. These are what we call pink sheet stocks, which are the companies Jordan Belfort pumped up in the movie The Wolf of Wall Street. And they are traded on OTCBB, over-the-counter bulletin boards. And I will be comparing these two kinds of penny stocks in just a second. So why are penny stocks considered risky investments? The first and the biggest reason is a lack of information available to the public. This really only applies to the OTC penny stocks under $1. Companies listed on the pink sheet are not regulated by the SEC and are not required to file financial documents for their investors. So without these documentations, such as the 10K, the investors cannot find out their cash flow, operating expenses, and whether or not these companies actually are generating revenue. As for the small cap penny stocks trading above $1 and are listed on the NASDAQ, these companies are required by the SEC to file their financial statements, register for offerings, and inform investors of important updates to the company. So in that sense, the penny stocks above $1 are a little less risky than the true penny stocks on the OTC. However, they are still sketchy and easily manipulated through misinformation and pump and dumps, which is the second reason penny stocks of all prices are considered risky. Many of these penny stock companies release news and pay promoters to pump their share prices up with sensational headlines, like I've talked about in many of my previous day trading videos. These penny stock PR often include keywords in the title, such as agreements, contracts, advancement, and strategic placement, etc., etc. These are what I call sensational keywords, because these sketchy penny stock companies take advantage of the fact that most investors and traders in the market are lazy, and they do not read past the headlines. If you actually dive into reading and analyzing the entire article, like I have in my past videos, you'll see that most of the time, the content of the articles are really all fluff, and they contain no real promise in the company's potential earnings. And of course, the purpose of these PR pump is to drive share prices up hundreds of percent, as we have seen in the past examples like OPTT, PPTH, YRIV, and ABIO. As the share price is hiked up, that's when the insiders of these penny stock companies start to sell and dump millions of their own shares on unsuspecting investors. Or sometimes these penny stock companies will take advantage of the pumped up share prices to issue offerings and raise more money. We've seen examples of these pump and dumps with OTC stocks. These penny stock companies recruit third-party online promoters to send out emails and publish misleading articles. While many people will argue that the penny stocks on the NASDAQ exchange are more regulated and less risky than the OTC penny stocks, the reality is that these sensational press releases are what's considered legal pump and dumps. And we are now trading in the gray area now. It is indeed legal in the eyes of the SEC to release exciting news about the company to the investors. There has been some extreme NASDAQ penny stock manipulation cases, such as LFIN and HUNT. Both of these companies released misleading news to drive their share prices up from under $10 to around $100. Those are basically a 1000% ROI pump and dump. Both of these companies were investigated by the SEC later on and delisted eventually from the NASDAQ to the OTC. That was at the expense of millions of dollars given by the investors. But let's be real here. These two companies, LFIN and Hunt, being delisted by the SEC, only represent less than 1% of all the penny stock pump and dump schemes. And unless it's really blatant insider trading or manipulation, these PR pump and dumps from small cap penny stock companies are really just everyday activities in the stock market. So I just want to raise awareness for new traders and investors through this educational video. Penny stocks are inherently risky investments. It's safer to always be skeptical of penny stock promotions, PR releases, and penny stock chat room recommendations. Always remember to do your own due diligence on the company. While I do think some penny stocks can provide great profit opportunities for day trading and swing trading, I would avoid investing in penny stocks altogether, unless you have real inside information about the company. Two very common misconceptions about penny stock investing is that many of today's big companies like Apple and Amazon were once penny stocks themselves, and that if an investor can buy into the penny stock at 20 cents a share today, then he or she can potentially make 100% ROI if the stock runs to 40 cents tomorrow. Both of these misconceptions are not 100% true at all. We must remember the single purpose why private companies choose to go public. Companies go public and sell their stock shares to investors in order to raise money, to fund their research and potentially develop products to sell. Stocks are not listed to make investors money. That's not the priority anyways. They are there to move capital from your pocket to the company's bank account. And if the companies are truly profitable, such as Apple, then yes, their stocks will rise in prices and make their investors money. But that is only true for real profitable companies such as Apple. The reality is that most penny stocks are actually losing money, and they do not even have a real product to sell. Instead, they just keep on selling shares of their stock to investors and raise more cash in order to operate and potentially pay their board members until one day the company goes bankrupt. In those unfortunate cases, the penny stock investors will lose 100% of their investment, and the insiders will walk away clean with their salaries and bonuses, paid by the investors' money, of course. Well, it is true that price fluctuations of some penny stocks from 20 cents today to 40 cents tomorrow could potentially make some investors 100% ROI. What most people fail to see is the downside as well. The price of the penny stock could just as easily drop down to 5 cents tomorrow, in which case the investors will lose 75% of their money in just 2 days. And more often than not, we see these penny stocks after a huge sell-off, they just keep on dropping in prices due to offerings and dilutions. And it's not uncommon to see these penny stocks get delisted from the NASDAQ to the OTC, in which case the penny stock investors could potentially lose everything. And of course, once in a while, we'll see some penny stock companies on the OTC that get listed onto the NASDAQ. These are companies that show impressive growth and finally meet the requirements. A perfect example of that is a marijuana stock called Aurora Cannabis, ACB. Their stock shares were once listed on the OTC pink sheet as ACBFF until October of 2018. However, the chances of most penny stocks growing their business to be like Aurora Cannabis is extremely low. So instead of investing your hard-earned money into penny stocks, I think the wiser long-term decision would be to invest in established companies such as Apple, Facebook, and Disney. Sure, you may not be able to own as many shares if you were to buy penny stocks traded under $1, but the long-term percentage growth on established companies is undeniable. These investments are much safer as well. Don't get me wrong, there's definitely a lot of money to be made in penny stock day trading and swing trading. That means you'll just be buying and selling these stocks intraday or within a short few days, instead of over the course of a few months or a few years. And those are the strategies I focus on my YouTube channel. Investing or trading any kinds of securities involve risk. Before throwing your money into just any penny stocks, make sure to do your own research and establish your own risk-reward profile. Always be skeptical of press releases and do not follow others' alerts. This video is not a financial advice to buy or sell any stocks, but to inform you about the potential risk involved in penny stocks, as well as the upside if you learn to day trade or swing trade them correctly. If you're interested in more detailed day trading and swing trading strategies, feel free to check out my videos down below. If you found this video helpful, please drop me a like and subscribe for more free content in the future. And remember to comment down below if you have any questions for me as well. This is the Humble Trader. Thank you guys for watching, and I will see you next time.